If you really want to get the pulse of the economy, I mean the actual pulse, without all the hype, you need to stop looking at tech stocks.
Right.
Seriously, for a minute, just ignore the AI forecasts, ignore everything else. If you want to know what the machine is really doing, you look at the highway, you look at the
It
trucks.
sounds so analog, but it's absolutely true. Stuff still has to move from point A to point B.
Exactly.
And specifically, you want to look at a sector called less than truckload shipping, LTL. It is probably the most honest economic barometer we have.
Because if factories aren't shipping parts, they just aren't making things. It's that simple. And that is why today we are doing a deep dive into Old Dominion Freight Line, ODFL,
They just released their Q4 2025 earnings report on February 4th.
and looking at the numbers, mixed is probably the kindest way to put it.
Mixed is very diplomatic. Some of those numbers are, well, pretty ugly if you don't have the full context. You can't just look at the headlines here.
And that's our mission today. We are going to decode these signals. We've gone through the whole earnings call with CEO Marty Freeman and CFO Adam Satterfield. We've parsed the press release, all of it.
And on the surface, yes, revenue's down, tonnage is down. It looks bad.
But underneath that, there's this incredible story of what they're calling a coiled spring.
It's a fascinating strategy. I mean, how do you run a business when you're convinced a boom is coming, but today's reality is, well, a freight recession? Do you cut back or do you double down?
It's a huge bet. So let's get into it. Section 1, the ouch numbers. We have to start here because there's just no spinning some of this.
No, you have to face the music. And this is a freight recession that's been going on for a while now. This isn't new. We're talking about 3 years of this sort of grinding, slow industrial economy.
Okay, so let's hit the top line number. Revenue for the quarter was $1.31 billion. That's a 5.7% drop from last year.
Which is a real number. That's not a blip.
No. And it's driven mostly by volume, right?
Right. They're LTL tons per day.
Yeah.
So literally the weight of the stuff they move was down 10.7%.
Wow.
Yeah. There's just less stuff moving through the system.
Now, when I saw that, I assumed it was just a steady decline. But when you look at the monthly numbers they gave, it was more like a roller coaster.
The volatility is key. It shows you just how choppy the waters are right now.
So, okay, October was down 5.3% from September. Then in November, you get this little glimmer of hope. It goes up 2.6%.
And you think, okay, maybe this is it, the turn.
But then December comes and it drops again, 4.0%. And January 2026 starts with a thud, down 9.6% year over year.
Now, they did say there was some noise in January. They pointed to a pretty big snowstorm that caused disruptions.
A snowstorm, does that really explain a nearly 10% drop? It feels a little like a the dog ate my homework kind of excuse.
It explains some of it, for sure. But no, not all of it. Even with good weather, the trend is still bouncing along the bottom. We haven't seen a real breakout yet.
Okay, let's talk about the key metric here. The operating ratio. OR. Can we just define that for everyone? Because usually a high ratio is a good thing, right?
In most things, yes. But in trucking, it's the opposite. It's like golf. Lower is better.
Right.
The operating ratio is just your operating expenses as a percentage of your revenue. So an OR of 80 means it costs you 80 cents to make a dollar.
So you want that number as low as possible.
Exactly. And Old Dominion is legendary for their low OR. They're usually in the low 70s. But this quarter, it got worse. It went up to 76.7% from 75.9% a year ago.
So they got less efficient. Why did they just get sloppy?
No, not at all. They lost their leverage. It's a concept called deleveraging. Think about it. They have huge fixed costs. Service centers, trucks, technology.
The lights have to stay on whether one truck shows up or 100 trucks show up.
Precisely. So when your volume drops 10%, those fixed costs suddenly become a much bigger piece of the pie. Their overhead costs went up by 140 basis points as a percentage of revenue. That's not mismanagement, that's just math.
Okay, so that's the bad news. Revenue down, volume down, efficiency down. You'd think management would sound panicked.
But they don't at all. The phrase on the call was cautiously optimistic.
Which can be corporate speak for, please don't sell our stock. So what are they seeing that we're not seeing in these top-line numbers?
It really boils down to two things. The ISM print and a little detective story about the weight of their shipments.
Okay, let's start with the ISM, the Institute for Supply Management Index. Why does a trucking company care so much about that?
Because it's a leading indicator. The ISM is a survey of purchasing managers in manufacturing. It asks, are you buying more stuff to build things? And recently, we got a strong print. It crossed over into expansion territory.
So people are ordering the raw materials, the steel, the plastic, whatever.
Exactly. And there's usually a lag of a couple of months. First you order the stuff, Then you make the stuff, then you ship the stuff.
So they see the smoke and they're betting the fire is coming.
That's the theory. But the data point that I found even more interesting, because it's more immediate, was the weight data.
Yes, the weight detective story. This was fascinating. Break this down for us.
Okay, so normally, from November to December, the average weight per shipment goes up about 1%. It's just seasonal.
Right.
This year, it went up 2%. It doubled the normal increase, and the average weight hit 1,520 pounds.
And why does that matter? Why is a heavy box better than a light box?
Because heavy freight tends to be industrial freight. Consumer goods, sneakers, Amazon boxes, they're light, they take up space, but not much weight.
But machinery, parts for cars, raw materials, that stuff is heavy.
Exactly. The CFO, Adam Satterfield, said this could be the early innings of the industrial economy heating up again. It's a signal of what is being shipped, not just how much.
It's like if you're watching a grocery store. You don't see more shoppers yet, but you notice every single person walking out is carrying 4 heavy bags instead of 2 light ones.
Perfect analogy. You know something is changing in their buying habits.
Satterfield also mentioned something about truckload spillover. What's that?
So during the recession, the big full truckload carriers got desperate for work. They started taking smaller, partial loads just to keep moving.
They were poaching business from the LTL guys like Old Dominion?
They were. But now, as the economy improves, those big trucks are getting full again with their normal single customer loads. They don't have space for the smaller stuff anymore. So that heavy freight spills over back to Old Dominion where it belongs.
So heavier shipments are a sign the whole system is getting tighter.
Correct. And that's ODFL's sweet spot. About 55 to 60% of their revenue is industrial. Satterfield had that great line about moving everything, including the kitchen sink.
And he said, if housing starts to improve, we move the faucets too.
Just shows how tied they are to the real physical economy.
So that brings us to their strategy during all this. Most companies, when business is bad, they slash prices, they have a sale.
A race to the bottom.
But Old Dominion did the exact opposite, which is just incredible.
This is their hold the line strategy. Volumes are way down, but they increased their revenue per hundredweight. Their yield by 4.9%, excluding fuel.
How do you do that? How do you charge more when demand is weak? Why would any customer pay a premium right now?
One word, service. They have a 99% on-time record. Their cargo claims ratio, which is how often they lose or break stuff, is 0.1%.
0.1%. That's basically perfect.
It's insane. And in a world of supply chain nightmares, that reliability is worth a lot of money. If a critical part doesn't show up for your assembly line, that shutdown can cost you tens of thousands an hour.
So saving a few $100 on shipping is a bad bet if it costs you $50,000 in lost production.
You got it. They refuse to chase what they call bad freight. They'd rather run a truck half empty than fill it with freight that's low margin and high risk.
That takes a lot of discipline.
It does, and you see that discipline in their costs, too. Even with all the volatility, their direct operating costs stayed flat at 53% of revenue.
And that's the stuff they can control day to day.
Exactly. Fuel, driver hours, things like that. Keeping that number steady shows just how tight a ship they run operationally.
So they're running lean, charging a premium, service is perfect. But now we get to the really daring part of the strategy, the coiled spring.
This brings us back to those fixed costs we talked about, the ones hurting their OR.
Right.
It turns out that's intentional. They are purposefully carrying about 35% spare capacity in their network right now.
35%? That sounds like a crazy amount of waste. A third of your network is just sitting there, empty. Most shareholders would be screaming to cut that.
And that's what most of their competitors do. They run lean. ODFL runs with a huge buffer. It's a massive gamble because they are paying to maintain all that empty space right now.
So why? What's the payoff?
The payoff comes when the spring surge hits, when that economic recovery finally happens and demand explodes.
All the competitors who cut to the bone, they're stuck. They can't hire people fast enough.
Exactly. It takes months to ramp up. But Old Dominion, they can just flip a switch. They can say yes to all the new business immediately because the capacity is already there.
It's like you said before, keeping the guest room made up all year, it costs you money in heating and cleaning. But when the whole family shows up unexpectedly for a reunion, you're the hero. You're the only one who can host.
And being the only one who can host means you steal massive market share. That is the coiled spring. You absorb the pressure now to expand with incredible force later.
And it's not just the buildings, right? It's the fleet, too.
Oh, yeah. Their average tractor is only 3.9 years old. It's a super young fleet. because they kept buying new trucks right through the downturn.
I did notice, though, their CapEx plan for 2026 is actually down. It's $265 million, which is way less than they've been spending.
It looks like a cut, but it's really more of a victory lap. They aren't cutting back because they're in trouble. They're cutting back because the work is done. They already spent the $2 billion over the last 3 years building out the network.
So now they're just sitting there, engines idling, waiting for the green light. What's the guidance for Q1?
Well, don't get too excited yet. The guidance is still pretty soft. Revenue between $1.25 and $1.30 billion. And they expect the operating ratio to get a little worse, which is normal for winter.
So the pain isn't quite over.
Not yet. And they have inflationary headwinds. Satterfield is expecting cost per shipment to inflate by about 5 to 5.5%.
And what's that from?
You know, the usual suspects. Healthcare, new equipment, wages. They really need that volume to come back to help absorb those costs. They can't just raise prices forever.
But even with all that, they're taking care of shareholders.
Oh, absolutely. They just raised the dividend 3.6%, generated $1.4 billion in cash flow last year, and they bought back $730 million of their own stock.
That's a statement. Buying your own stock when revenue is down says, we think we're undervalued.
It says, we believe in the coiled spring. They're putting their money where their mouth is.
Okay, last question. We have to ask. AI. Is a trucking company really using AI?
I love Satterfield's answer to this.
Yeah.
He basically said, look, AI is the buzzword of the moment, and then he just moved on.
Right.
But he did clarify, yes, they use it, but for practical, boring stuff. Optimizing routes, pricing tools, line haul planning, they're using it to keep those variable costs at 53%. Not to sound cool.
I like that. Practical AI.
It fits their brand perfectly. No flash, all execution.
So let's wrap this up. The big picture. Old Dominion is taking some hits from the freight recession. Revenue's down. OR is up.
But they haven't compromised on price or service. They're accepting the short-term pain for what they see as a long-term gain.
And they are sitting on this massive 35% excess capacity, a brand new fleet, just betting everything that the ISM data and those heavy shipments mean a boom is right around the corner.
The spring is coiled. They are built for recovery.
But here's the thought I want to leave everyone with. The strategy's brilliant, it's disciplined, but it all hinges on one thing.
The economy actually has to turn.
That is the whole risk. They are paying for that 35% buffer every single day. Every day it sits empty, it costs them money.
A lot of money.
What if these green shoots are just weeds? What if the ISM was a false positive? What happens if that 35% sits empty for another year?
Then that coiled spring starts to get a little rusty. They're bleeding efficiency for a party that might be delayed.
It's a very high-stakes game of patience. They're betting that being the best prepared host on the block is worth the cost of keeping the lights on.
And to be fair, that bet has always paid off for them in the past.
Yeah.
But the past isn't always a guarantee.
We'll be watching to see if those grocery bags keep getting heavier. That's it for this deep dive. Thanks for listening.
Keep your eyes on the trucks.